futures and Forex markets for the last 12 years. And in 2006, founded my company, E-Trade FX. I am Series 3 Commodity Futures and Series 34 Retail Forex license and registered with the Commodity Futures Trading Commission and the National Futures Association as a commodity trade advisor and introducing broker. I have worked as an advisor to large hedge funds and individual traders worldwide, providing daily consulting for short, medium, and long-term trading, while also providing very specific risk management models with preservation of capital, the primary focus, along with steady growth. I have further worked as a market analyst for TraderPlanet.com since 2008, a prominent social media website that globally connects traders, where I provide daily commentary on to a large number of followers in the Forex, futures, and stock markets. Now, in today's webinar is titled Technically Speaking. The content, we're looking at a midweek review of all of the U.S. majors pairs and how to trade them, long-term charts for short and medium-term trading based around the weekly setups. So essentially long-term charts for short to medium-term weekly trade setups, identifying sideways pairs versus trending pairs. We're going to be looking at some key indicators and how to combine them for both trending and sideways markets, and of course, when to play the overbought and oversold signal and when to simply ignore it. So we've got a busy 40 minutes ahead of us, so let's get started here, guys. Again, I want to thank everybody for attending this morning. I really appreciate everyone coming out to view the webinar, and I hope everyone enjoys it. Any questions during the webinar, I'll be happy to take them at the end of the presentation in about 35 minutes, but I will be checking the question queue during the course of the webinar. So to start, let's look at the midweek review of the U.S. majors and how we're going to trade them and what we talked about in the last webinar. What I talked about in the last webinar was essentially that the dollar was basically confined. So the first thing we want to do is we want to go out to our longer term charts. We are at year end here. We're approaching the end of 2013, and we don't want to get caught in a bull trap, and we don't want to get caught in a bear trap. And what I mean by that is there is seasonalities at this time of year in currency. That's the one thing that's fantastic about currency trading, is that it's very, very repetitive. So when we look at this, we can see that, again, we look at our monthly cycles that I talked about in the previous webinar, that in most cases the dollar strengthens in the first week of the new month, and it weakens around the middle of the month. Now, the month of December is usually different, and this cycle is outlined in red. In red is where the dollar sells off on the 16th, and in the yellow line here, you can see that's where the dollar did not follow that cycle. So about 75 to 80% of the time, the dollar is selling off or strengthening around these lines that I've drawn in. Now, when we look at things from a long-term perspective on the U.S. dollar index, the first thing we want to identify is the key levels. We've got the upper Donchian band, the upper trend line on the dollar index coming in around 84.43. The upper Donchian band is at 84.97. Now, what I want to talk about, and I'm going to talk about extensively through the course of the webinar, is the center Donchian band. Now, the one thing that I like about the Donchian bands that I've talked about before that I like a lot better than some of your other range identifying indicators like Bollinger Bands, they're very non-committal. And what I mean by that is they tend to float around and the lines are pointing up or they're pointing down, but they're not committing to anything. And the one thing about the Donchian band, when we adjust our settings out to a little bit longer, to a 30-day Donchian band, we get a good solid line. Now, the idea with a Donchian band is when it's flat, we can identify the range. Now, you can see right here on this lower Donchian band, even though we're a considerable ways away from where the current market price is, the Donchian band has actually turned up. That is a warning sign for me, and this is what I advise my own direct clients, that this could be potentially an issue here. And more importantly, the center Donchian band. The center Donchian band is an absolute critical indicator as we stay up in these upper quadrants between the center Donchian band and the upper Donchian band. If we break below this blue line, then this would tell us that we're predominantly going to weaken, and we're going to probably target this lower Donchian. So as you can see in the monthly time frame, we broke above this Donchian band way back in essentially December of 2012, about a year ago. And for more or less the last year, we have stayed above this center Donchian band all the way into December of 2013. Very interesting when we look at this. So the dollar is not the strongest currency, but it's not losing the kind of ground that maybe some people would have us think that it is. Now, again, we want to move backwards from longer. Now, a lot of your traders, they'll go into these 1 minute, 5 minute, 15 time frames, and they'll try and figure out what they're going to do with their trade from there. Just like drawing our trend lines. When we draw our trend lines, your average trader will draw trend lines from left to right. We draw our trend lines from right to left. We take the most exponential price and trade from that. Because what happened back in 2008 or 2003 is not necessarily relevant to what's happening here in 2013, or more importantly, what's going to happen in 2014. That's the issue here. So when we look at this, we can see that we want to look backwards. So we start way out on the monthly, which is absolutely lagging. There's no question about it. But the point is, we can identify where we are in the range of the dollar. So when we look at this and we come into the weekly, we can identify some pretty strong trend line resistance. Again, using this type of trend line where we're looking for two lower points, one high point, and then two lower points that will create a trend line. Same we can see right here. Two candles to the left, two candles to the right, that creates a high point. We then connect it to this point right here on November the 10th. That creates a trend line on the weekly. We do the same thing on the bottom. We look for a low point, then we have two candles to the left and two candles to the right. That creates what's called a demand line. So when there's demand for something, a currency, price will go up. When there's supply for something, supply is filled, price will go down. So right now we see price moving lower. As we start to move back towards our daily time frame, we can see that we have a lot of congestive resistance up here in the dollar, and it's starting to break lower. But you can see that this Donchian band is actually starting to break higher. So this type of divergence is what we're looking for. Now, we look at our stochastic. We are in heavily oversold territory. Now, the issue with this is what we look for is the time when to play an overbought and when to play an oversold signal. The time to play a signal like this, guys, is when we see the slow and the fast stochastic coming out of this 20 area. When you don't want to play an overbought and oversold signal is when the market is below 20 and above 80, because the market can go the stochastic indicator can basically become dormant. And you can see right here that if we hit overbought very quickly, the RSI, it continued to tell us to stay in the long. The stochastic said that we were basically overbought and was going to move lower. That's not what happened. You can see that the market aggressively moved higher. So we need to know when an overbought signal and when to play an oversold signal. So from an overbought standpoint, you can see that we've stayed up above this 80 line, but as we started to break back under the 80, moving back down towards the 20, that is the time to take advantage of the stochastic indicator. The same thing here. You can see that we crossed the trigger on the stochastic in heavily oversold territory, but only when it started to come back up above the 20 line was this signal confirmed. So essentially, always remember this. When your stochastic indicator, regardless of which stochastic you're using, be very cautious of it when it goes below the 20 and when it goes above the 80. Then we have the RSI. When we look at combining these types of indicators, we look for momentum. Now, you'll notice with both of these indicators, I have a 60, a 50, and a 40 on the RSI. On the stochastic, I have an 80, a 50, and a 20. Always have a center line. Just like a Donchian band, always have a center line. It's very, very important because it tells us where we are in the current cycle. That is absolutely critical. So for now, looking at past cycles, this would tell me we're going next week into the FOMC. It would be more likely than not that the dollar is about set for a rally here very, very soon. So as we start to come into our lower time frames, again, we're using those longer time frames first to assist us with shorter and medium-term trading. We're not going the other way around. So if we were doing our trades from left to right, we would be looking at the 1 minute, the 5 minute, the 15 minute, the 30 minute. We do not want to do that. We want to always make sure we're going from right to left on the MT4 or whatever charting system you're using, that we always go longer and then we start coming into the shorter time. So we always look at the bigger picture and then we come into our additional trading. Now, when we start to look at our Forex pairs and we start to break this down, again, we want to come right back to the monthly time frame. Now, our monthly time frame tells us where the key levels are, where we are in the overall cycle, usually on a year-over-year basis. So the euro right now is sitting, and we can see here that I have a number of different indicators in here. I have a trend line that we have broken through this trend line on the monthly indicator. I've got a 100-day, a 25-day EMA. Everything here is pointing that the euro is going to go higher. But again, guys, this is something we want to look at. When we're using a Donchian band, you can see that this Donchian band, if this was a true signal, this Donchian band would likely break the upside. That's not happening yet. So the divergence here is that the euro is going higher in the monthly time frame, but the Donchian band is calculating the levels lower. So while we may be able to move higher, there's a red flag on this particular trade. So when we start coming back down to our weekly time frame, we can see now all of a sudden things start to change a little bit here. And what I mean by change a little bit here is that we start to see that there's a top in place right around this 138.07. Now, the probability is, and trading is based on probability and seasonal patterns, past indicators, we can assess here that there is probably going to be some sellers coming out into the market here very, very soon. So we have the trend line coming in at 138.01, and then we have that upper Donchian band sitting at 138.31. So basically, if this is going to break higher, then we need to clear these two levels. This is not going to be an easy thing for the euro to do, guys, but it very well may do that. So then we look at the position of our other indicators. When we're talking about using key indicators and how to combine them for trending and sideways markets, when we look at this on a weekly time frame, this is clearly trending. This has been trending for some time. We have a lower trend line right here. You can see there's our low point right here on the weekly time frame. We have two candles to the left, two candles to the right of this low point. We have the 100-day. We are above this center Donchian band. We have been above this center Donchian band. Essentially, we broke above it back in June of this year. So this trend is not that old. But we can assess when this took place. We're traced exactly back to the center Donchian band. Plus, we've drawn a trend line, off of this candle right here, which goes back to November the 11th, or November the 3rd, So when we look at these things, then we can make an assessment that, okay, we're going higher, but we have this point up here, and it's created a trend line, and we have the Donchian band for support. Our additional indicators, again, this 50 line is very, very important. When we look at the 50 line on the stochastic, you can see we've crossed over and we've pushed above it. But when we look at the RSI, again, the RSI this is an 8-period RSI. People use 14, 12, 8, 6, 4. I've seen all kinds of different combinations of RSIs, and you're free to use whichever one you want. This is for educational purposes here. This tells us here that essentially the RSI is a little quicker to react to market conditions. And when the RSI broke back above the 50, we did move substantially higher. And we've been continuing to move higher. But we've got a problem area up here. Now, most traders that will just blindly go in here and buy this, that's not a great play. That's not a great play at all. There's two ways to play this. We can play a breakout scenario, and we can buy right now in anticipation that we are going to break through this, or we can short it, and we can put our stops very tight around 138.60. Either one is a reasonable play, but buying at this particular level, we look at the fundamentals here, going into the FOMC next week, that's not going to be an easy trade, guys. That's not going to be an easy trade at all, because in most cases, the people that have been long all of this time are going to take profit, so we're going to look for a substantial pullback on this pair. So when we come back down into play, we can start to see a different picture forming here in the daily, but we're still in very long-term time frames. And again, that Donchian band breaking lower to actually meet the market, and we're sitting on that area right now at 138.12. Excuse me. Now, when we see this, our other indicators are, again, the stochastic has moved into overbought territory, and this is something I definitely want to point out here. the difference in combining indicators and when to play the overbought signal and when to change gears and play momentum. And when I look at this, this is a fantastic way to look at it right here. We have our stochastic was overbought here, and our stochastic was overbought right here. Now what we want to do is we want to look at how the RSI responded to this. The RSI is set up like this. You can see continue to move higher, and more importantly, on this particular section right here, the RSI is telling us to stay long. Now the theory, and this is something again that I work on with my own direct clients, is that we have a difference between a momentum play and an overbought and oversold condition. We can see that the overbought condition, most traders will sell. That when they see this, they are going to sell along this trend line. They would not even think or consider to buy this. And the reason they won't is because they're comfortable. They are comfortable selling something when it moves higher. What I can tell you right now is that in the current market system, whether you're in stocks, futures, or commodities, there is more and more algorithmic systems coming into the market. And these algorithmic systems don't care how high it is, they buy. They don't care how low it is, they sell. That's what they do. So buying a breakout momentum like this, we can see that the RSI was the clear winner here. Now, when the RSI and the stochastic agree together off a trend line, then we can reassess. In this particular case, the stochastic did very good. But again, this point right here, where the stochastic broke back below the 80 and the RSI started falling, that's when we have confirmation that this thing is going much lower. And it did. And to the stochastic's credit, it said, look, right here, we became oversold. That's probably a bit, but that wasn't it. It's lower down here for quite some time. And then the RSI was, again, not in agreement with the stochastic. But when the two agree together, that is when you want to play the signal. And in most cases, the stochastic will have to be, I'm just going to change this and bring this back up in one moment here. These lines are very important. Right here, this 20 and this 80 area are important that the stochastic be inside that area. Very, very important. And the RSI, a momentum play, we're going to break above 60. For the upside, right here, you can see that move right there. And on the downside, a break below 50, and then followed up with a break below 40. This is a very effective momentum play. I am not using an RSI or even suggesting here or to my own direct clients that we use the RSI to gauge an overbought or oversold condition. Mind you, you could, and some people do, but just remember, the momentum play is just as much your friend, and sometimes it's your best friend when compared against conventional indicators like MACD, stochastics, and things of this nature. That's very important. So we've had a good look at the euro, and we can see what's going on. We can see it's pushing here. In the H4 time frame, again, we've got resistance forming around this 137.94. That's the bottom line here, is that there's a lot of resistance starting to form on this particular pair. Could it break through? Yes, but remember, trading is based on probability. You have two options here. Buy this breakout or sell into strength and keep your stop tight. Another alternative here that I teach to my European guys and my Canadian clients and Aussie clients that are not in the U.S. that have the ability to hedge is you can straddle this. And by straddling it, what I'm saying is that, for example, if you want to go short, then you can sell right now and you can have a buy limit order with no stop on that short trade with the stop on the short trade sitting about 138.40, and then you have a buy order to go in at 138.50. So when one order cancels out, it activates the other. And that's a straddle play that people use in futures, and a lot of people take advantage of that in the currency markets too, because the bottom line is this could break either way. Just know your levels and have a plan going into it. Now, when we go into, and again, going into that longer time frame, again, with the looking at this in the H1 time frame, it just looks like an easy buy signal, guys, but in actual fact, it's not. There's a lot of headwinds up here. So the average trader that comes in and starts looking at these lower time frames and disregards these higher time frames, you can see that the higher time frames are directly telling us what to do in the short and the medium term weekly trade setups, which will directly lead me into Great Britain, U.S. How are we playing it? How have we been playing it? this past few weeks since the last webinar? Well, what I can tell you is that this does not require complex mathematical theories, guys. It does not require Fibonacci. It does not require Elliott waves. It does not require an above average knowledge in economics. It doesn't. If your trade setup is correct, then you can see what is happening here. So when we look at this trade setup, we have the upper Donchian band at 166.17, but we have all this other resistance sitting in here around the 164 area. We have longer term trend lines in around this area. So we have been in this area now basically since the last webinar, almost since the last webinar. The entire last week, how we've been playing this is basically selling into this area. We have broken below the 100-day moving average. We have broken below a lot of these key levels way back in 2008. Now, pound dollar may move higher, but the bottom line is the first thing we do is come out to the longer time frame. When we come out to the longer time frame, it doesn't look like a no-brainer buy here. All of a sudden, the buy looks like it could be very, very dangerous up here, buying, considering the situation with the pound and where we are in the yearly cycles. Now, in this, what I can tell you is that last year, on December the 14th, 2012, the pound hit its peak for the year and then went on to fall 2,000 pips. I'm not saying that that's what's going to happen this year, but what I will say, and I'm going to point this out so everybody can see it, is you can see right there that on essentially the pound dollar peaked towards the end of 2012 at the exact same level that we're at right now. So you have a seasonal pattern here that you have to deal with, that there was substantial weakness. This was a violent sell-off in the pound. Then we have our resistance areas on our monthly time frame. So the people that are buying pound dollar, it's not to say that they're not making money and they're not good trades, but they have to be very, very cautious because they don't realize the bull trap that's being set up there. Okay. And that's where we have to be cautious, right or wrong. And again, a very, very good straddle play. So the straddle play here, or if you don't have the ability to straddle, that's fine. You can still do the same thing. What we've been doing with my own direct clients is selling into this area for the last 7 days. So when it moves up above 164, shorts are activated, stops are sitting at 165. When it moves lower down towards the 163, 163.20, the trade is closed out. So, and then the next day we go in, we do the exact same thing again. The next day, same thing again. The one thing with Forex, guys, is that tomorrow will be the same as today with a slight extension of the same range. That's a critical thing to remember here, because this is not a complicated trade. It's only complicated if you're going in there with 20 pip stop losses, leveraging your account out, trying to scalp a few pips. That's the hard trade. When we come out to the longer time frames, we can clearly see what to do. When we look at this, you can count them. 1, 2, 3, 4, 5, 6, 7, 8 candles. And today's trade, no different. Selling it again. So we sell it up into this area, up into this massive trend line sitting up around 164.38 that's now on the daily time frame. This is not a difficult trade. Could I get stopped out? Absolutely. Will I get stopped out? There's a 50% chance. By the time I get stopped out, or by the time you get stopped out, knowing these levels, it doesn't matter. You've probably already booked, like me, 300 or 400 or 500 pips. It makes no difference. Did I rely on an Elliott wave or a Fibonacci level? Did I look at any of these things? I could care less. It means nothing, because the bottom line is I know those upper levels, the seasonality of the pound. It's good for buyers, for bulls to take control of this market. It's not going to be easy. Could they do it? Yes. But it's not going to be an easy task. And remember this, they will very seldomly will they ever do it on the first attempt. They will have to take multiple attempts at this before they actually break through that level. If they do break through that level, then you buy. That's no problem. But be very cautious of false breaks. When will you see a false break? Usually on a Sunday night. That's the key thing. Now, looking at our indicators here on the daily, all of a sudden we've got a problem. Our RSI, our RSI is showing divergence. It's starting to move lower, moving down. Our stochastic is sitting below that 80 line and looking to cross that trigger back to the downside. This is actually setting up for a short. And then when you come into the H4 time frame, all of a sudden, when you're coming now down into your lower time frame, taking that longer term perspective, Well, we've got massive trend lines sitting up here. I can pick that up on a day-over-day basis. We've got a trend line break of the H4 time frame, and down goes the pound. Now, we've got targets on the downside that using the shorter-term time frame, use them to exit these trades, 162.91. There it is. So we know we can probably target somewhere down around the 163. You should probably exit this trade. The primary trend is still up. And just keep working the orders. Do I need to go out and trade 10 other currency pairs at once? No. And this is with some of my clients who are stock traders, and they'll hold 20 different stocks at once. There is no reason to do that. When if you've got a cow that's producing milk, stay with it. You don't need to run out in the field and start chasing other cows. Everything you need is right here. So trading this on a day-over-day basis on the last 7 days, you've had a not just a very successful week, you've had a very successful month. Now, again, that's when our other indicators are going to come into play. We want to watch we look at that RSI. We want to watch that RSI very, very closely because it's breaking below that 40, and you can see the market is starting to accelerate. But our stochastic is starting to bottom out here. So using these lower time frames is helpful for both the entry and the exit. Very, very important stuff. Probably you don't like other things, example, is your favorites. Probably you don't like other things, example, Fibonacci is your favorites. No, I do not like Fibonacci. For the most part, FX Boinky is sending that question in. Fibonacci is not high on my list of indicators at all because I believe that, right or wrong, I can't say whether brokers are running stops or not running stops, but they seem to run them a lot around those Fibonacci levels. And that's what makes me a little nervous. So I'm going to look for unconventional ways. Whatever the overall market is doing, I will tend to do the opposite. Or I will take into consideration what they are doing, and I will really look hard at that to see if that's really the right thing that I should be doing or not. And that is something I definitely encourage my own clients, and I would encourage everybody here on these webinars to think outside the box here, guys. If you think outside the box, because everybody else is thinking inside the box, or most other people, when you look at current CFTC data, I think it's some 70% of traders don't make money. 75% of traders buy CFTC data in futures forex, and I think that applies to stocks. I think stocks is even worse. So when we look at that, we want to be in the 30% group. We don't want to be in the 70% group. So if the entire group thinks that the market's going to bounce, or 70% of the market thinks the market's going to bounce at a Fibonacci level, then chances are, and it doesn't, they run the stock the other way. That's a problem. Now, Fibonacci does work. Don't get me wrong. Am I going to rely on it? Never. I would always make sure I'm looking at additional indicators for that. With U.S. Swiss franc, going into that, we've taken a good look at pound dollar. We've looked at that key level. We know what the midweek that we want to continue playing what I've said. Sell into that area or buy on a dip. And if you're buying on a dip, just keep it tight because we know looking at that seasonality of that 2,000 pip move, that is not something you want to take lightly. Now, with the British pound, I will say, like I said in the last webinar, the former governor of Canada, Carney, is now at the Bank of England, and this guy is a currency hawk. There's a better than 50% chance pound dollar could take out that 164.50 level. And if it does, we've got a target back up around the 167. So always remember that. When we look at this U.S. Swiss franc, we're going to come back and we're going to look at this again. We're still above this center Donchian band, just like that dollar index. And we're looking, the U.S. Swiss franc is a derivative of Euro-US and Euro-Swiss franc. There is no such thing as U.S. Swiss franc, guys. It's a synthetic cross pair. That's what it is. So going into a whole bunch of analysis onto this is not something, all you have to do is look over at Euro-US or look at the dollar index because this is 100% correlated to the dollar index. Now, what I also do is I use Vantage Point for some of my intermarket analysis. And when I bring that up and I look at things with the dollar index and the U.S. Swiss franc, then I can make the assessment from here that essentially there's 100% correlation. Okay? Absolute 100%. If this dollar index is going down, the U.S. Swiss franc is going down. Bottom line. And these types of calculations are invaluable to me. They're very, very important because you can see right there in the dollar index there, the dollar index there. It is absolutely by the move. So if we're anticipating a reversal in the U.S. dollar index, we should expect a reversal in the U.S. Swiss franc. Now, the U.S. Swiss franc is going to be dependent on Euro-U.S., whether or not it can take out that 138.40, 138.30 level. If it can, then U.S. Swiss franc will continue to move lower. The U.S. dollar index will continue to move lower. That's just a fact. But again, most people don't have access to the U.S. dollar index charts. They have access to charts like the U.S. dollar index that are kind of broker manufactured. FXCM, I know, has one, the FXCM dollar index. That is not a true dollar index. Some people will say that the dollar index is antiquated. Well, not really, because the major pairs it's still affecting. That's your pound dollar, euro, US, US Swiss franc. It still has a heavy effect on those. So it's still valuable to us, regardless whether they think it's antiquated or not. That's certainly up to them. But that's right. But, now, how are algos set? I'm not sure what you mean by that one. You have to clarify that question. Now, when we look at this again, we're looking at correlations that the dollar has. When we look at some of our pairs, the pairs we've looked at so far, pound dollar, you can see that correlation is not always 100% here, but it is very strong. Now, when we look at this again on the pound dollar, the break here and the break on the dollar index down led to a pound rally, but that's not always the case with the pound. The pound can be funny. It's not as high a correlation with the dollar index is what the euro is. The main pair here is Euro Great Britain. That is the main pair there. So we can look at these correlations, but again, we look at Euro US and there's that correlation and 100% the dollar index. So the other brokers can create their own form of the dollar index. They can include the Aussie, the New Zealand, and stuff like that. But that's not going to help you a lot with Euro-US, with US Swiss franc, with pound dollar. So just remember that. It's very important. Now, again, using a product like Vantage Point, I'm able to very quickly do the intermarket analysis aspect of it. It's very helpful to me. Now, as we come into our US-Japan, so our US-Japan is going to look very, very much like that pound dollar, and it's struggling. Now, with my own guys, we are prepared to buy this breakout level, and you can see our Donchian band at 103.72. Guys, I'm pretty sure the whole market knows this area. And you're going to have, this is a zero-sum game we're in for Forex. You have buyers and you have sellers. And everybody is split down the middle as to what's going to happen here. So when we look at our primary indicators, we have this trend line. We form a trend line up here. Again, we've got 2 candles to the left, 2 candles to the right. We connect back to a higher point back here in May of 2008. Let me just bring that in so everybody can see where this is connected to right here. And right here are our 2 high points. We then run a downward angle, creating that trend line to where we are here. Now, when we're looking at this level, we've got a couple of levels, 103.72, but we've got 102.79. We are able to push above it, but we're struggling staying above it. So there's, again, another great opportunity for a straddle trade, or you simply, you buy on dips. And right now we've got a key level, 95.36. I hope we don't get anywhere near that level, but, we know that we have a problem. It's not just, a flat out long zone right here. It's not. And that when we come to these longer time frames first, we can then assess what we want to do in shorter time frames. So when we look at this right now, again, we're coming up on the weekly time frame to that Donchian band. It's formed at 103.72. I'm sure the daily's pretty much going to show the same thing, 103.36. So you see, as we start to come down into the smaller time frames, our trend lines change a little bit, and it starts to fall. We have something going on now around 103.36. That's exactly where we failed this week, and now down we go again. We've broken the trend line, but we're above that center Donchian band. We've got a 101.30 and a 100-day moving average, which I'll work in there, 99.31. I don't think we're going to get anywhere near that area anytime soon, but we could get down here around 101.30, 101.50. That's absolutely possible. We can see we're losing our divergence. Our MACD on our median time frame is starting to lose it a bit. Our stochastic is crossed down. Again, we're inside that 80-20 area, but we're above the 50. So, and again, I've got that 50 line on that stochastic there. for that reason. As you can see, the trigger on the stochastic kissed that 50 and then went right back up. Very interesting. Okay, that's why that 50 is very important. Now, Ramesh is asking, can I suggest a reliable source for the U.S. dollar index? Yes, I can. And this platform that I have up here is called Windsor Direct. I have no affiliation with Windsor Direct whatsoever. I do not trade money. I do not trade money with them. It is simply, I've had a demo account with them for 15 years, and it provides free live data on the U.S. dollar index, the S&P 500, gold, silver, light sweet oil, NASDAQ. It's a very, very good platform. The demo is great for doing analysis, and then just execute your live trades in your live account elsewhere. That's what I would recommend. You said algo set to buy and sell. Can you explain that? Yes. Basically, to answer, the algorithmic programs in the market are basically computer generated. And they are set with certain indicators, and when it hits a certain level, they buy, and when it hits a certain level, they are forced to sell. They do not have an option. So when they do it in large quantities. So for example, when we look at the dollar yen right now, or more importantly, even that pound dollar, if the market cannot get above 164.50, 164.80, those algorithmic programs will all be instructed to cut that long trade. And that will probably happen tomorrow. If the pound dollar cannot retake 164.70, 164.50 and stay above that area, close above that area, in theory get above 165, these algorithmic programs are, and not just that, your big institutional banks, real money, they are going to execute, they're going to get out of those long trades. So when that profit taking takes place, that indirectly signals a long dollar trade. Not necessarily that they're buying dollars, but they have to buy dollars to execute that trade. You see the buy and sell button, but another transaction there. So always remember that. So in this particular case, the market is already getting nervous going into Wednesday trade, going into Thursday trade, holding long positions on US Japan, holding long positions on pound dollar. I think they will get equally nervous. Very, very nervous. We just jump back to Euro US for a minute here. When we look at this on a monthly time frame, it looks good, but on the weekly, you've got a bunch of resistance up here. And even on the monthly, it's overtaken some of the key levels, but it's still, that Donchian band is pointing down. The standard Donchian band is not pointing up, it's pointing down. That divergence alone warns me that this break higher is probably false. So always keep that into consideration. Now, I want to make sure I get through these current pairs. Let's have a quick look at what's going on with Aussie-US. Aussie-US, the first thing I'm going to do is come back to the monthly time frame. We have been down at this level multiple times over the last several months. So the first trendline support was created back on August the 1st, right here. We then went flying up off that. We hit the level, this 25-day EMA, also where the center Donchian band, guys. Remember I talking about that center Donchian band? There it is again. It's that Donchian band and then collapses. We're right back on this trend line support, getting very close to it again. The trend line itself will come in about 89.10, and then we have our lower Donchian band at 88.46. That's your buy zone, guys. That is your buy zone. And the correlation that I have seen as of late, if I bring the dollar index, the Aussie dollar, these two are not 100% correlated. As we can see, looking at the Vantage Point software, using a tool to calculate this, we have a correlation here, but as the Aussie went down, we can see right here the Aussie dollar and the US dollar have had a high correlation. And I've noticed this with the Aussie, the New Zealand, and the CAD, that when the dollar rallies, so does the CAD, so does the New Zealand, and so does the Aussie. That's what's been happening. It's the euro, the Swiss franc, and the pound that have the 100% correlation of the dollar index. So just because the dollar rallies, that doesn't mean that the Aussie, the New Zealand, and the CAD are going lower. That could be the exact opposite. That's what's been happening. And that, again, so when we identify these levels, we know a potential buy area. When we look at it in the weekly, we've got that lower Donchian band, 88.46, and more importantly, the daily. Again, sitting right around 90 area, 88, 90. That's a likely area to think about potentially buying. The stochastic, we broke above the 50. The RSI is struggling, absolutely. We're looking for the RSI to retake this 50 level, and then we can execute our long trades. And from there, I am going to jump directly into the US CAD because it's relevant. It looks, again, just like a pound dollar chart. We are stuck on this level. We can see that we've got the upper Donchian band, 106.56, trend line 106.56 in the monthly time frame. Sure enough, down it goes. You can see we've got all of these candles stacked up against this area. Now, let me bring this into perspective, guys. What I do for my own direct clients is that these are monthly candles. We have 1, 2, 3, 4, 5, 6, 7 months of this. Anytime we move up to this area, we buy, or we sell, excuse me. That's it. That's as simple as it absolutely gets. There is nothing else in there that I need to do this. Where do I want to buy? I want to buy off the lower trend line because it's very repetitive. We keep coming down to the 103 level. So the probability that we're going to move towards 103 in the months ahead is very, very high. In order for us to get the 100-day EMA up here at 108.79, we have to get through an absolute gauntlet of resistance. That's not an easy task. So, and as we start to break it down into the weekly, we can see what's going on in the monthly. So if we look at the monthly and then fast forward to the H4, then we use these lower time frames for a potential area to set our short. So for this morning, we look at the H1 time frame. We've got trend line resistance at 106.13. There was nothing wrong with shorting that today. We've got the center Donchian band right there, 106.12. That's not a great trade in the H1, but when we look at it in the H4, it's actually a very good trade. You can see when this trend line is formed, that's up around the 106.40 area. That was a fantastic trade to start the week. Now, US CAD's been moving very slowly, but it's been moving. So, but here, right now, we also want to make sure we look at this bottom here. And this is something where there's no divergence here. The lower Donchian band is broken to the downside, and the market is moving lower. That is consistent. The other things we've looked at here today are not really consistent, are they? You've got the market going higher and the center Donchian band breaking lower. That's not a good thing. That kind of divergence is the kind of thing that we look for to make sure we're not getting caught up in a false signal. Now, I want to quickly, before I go to take some questions and wrap up, I know I'm right on the time limit here again, New Zealand, U.S. New Zealand, U.S., if we come right out again for the monthly time frame, we have absolutely massive support sitting at the 77.80 level. Now, we also have the center Donchian band right now at 81.05, 81.05, again on the monthly, heavily supported area. And you can see for the last 3 months, they've been buying off this level. Bottom line, guys, 3 months. So when we look at it just like that US CAD, I see all this analysis on US CAD, fundamentals, this, oil, that. It goes on and on and on. When we simplify our trading down, we really have a better concept of what to do and not let all of this other voodoo and snake oil send us trading the wrong way. Look for divergence in your indicators. Very important. Are you going to rely solely on a Fibonacci or an Elliott wave or a Bollinger Band? Absolutely not. Combine it with other indicators. Preferably, I always combine it with an overbought and oversold indicator like a stochastic and then a momentum indicator like the RSI. That's a very powerful combination. When we look at this right now in the daily time frame, we've got pretty heavy support here too at 82.01. We're going to trade it on the daily. We have our stop below there, but on the H4, it's struggling a little bit. This is a big concern for me right now on New Zealand, 82.35. That's a big problem, is that we need to hold on to this. We're likely going to target this bottom area around 81.38, but remember, we've already identified the critical support down there. We would want to buy. If we can get down to that area, we see a big sell-off in the euro, a big sell-off in the pound, a big move higher in U.S. Swiss franc, that actually solidifies that we might want to get long Aussie U.S. and long New Zealand U.S., right? That's the way we want to think about this because we've looked at it. We've seen the correlation that these pairs have had. The New Zealand dollar, again, with that New Zealand dollar breaking higher, there's been multiple other times here looking at the software here that they've been highly correlated to each other. And the average person would probably never see that. So knowing that, some of these are seasonalities, but, it can go either way. But what I want to do now is I want to make sure that I stay within my allotted time. So let's go to some questions here. Hope you guys have a few more questions. I know I've answered a bunch of them during the course of the webinar. Okay, the first question here is, which broker do you have live account with? Predominantly on the retail side, I like FXCM. I do like FXCM, and I'm really starting to warm up to Vantage FX. They've had some pretty good clearing. They've got great spreads. FXCM, where you open your live account would definitely relate to where you live. Now, always remember in the U.S. that there is no investment protection of funds in those accounts, whether they're segregated or not. You're still an unsecured creditor, whereas the U.K., I think they have about 80K investment protection of funds. Here in Canada, where I'm located, we're very good. We have, I think close to $1 million in investment protection of funds. So that's always good. Our algos like EA robots, they are somewhat like EA, somewhat like robots, but robots are robots, and you want to be very, very careful with robots, because oftentimes what robots do is they, and this is why the CFTC has clamped down on some of the introducing broker licensing in the U.S., that you have to be registered, because what they do is they that trades 100 times a day, and then the person you buy the robot from says, okay, well, you have to open an account for me. The robot may or may not work, but they make a killing off of the commissions off of your trades. So really, algorithmic programs are the ones I'm referring to are more bank related, and where there's system setups, there are large institutional funds, that there's certain levels where their systems will have to buy or sell. They will have to, a retail trader could sit in a trade for 2 years. Institutional traders very seldomly do that. They are forced to exit those trades. So in the case like I've talked about with Euro US and Pound Dollar and US Swiss franc, particularly looking at Pound Dollar and Euro US, if those systems decide to cut those long positions because they are getting nervous because it can't break through, when those positions are closed, you could have massive institutional orders driving that market. You could have 10 institutional orders that could move the market by 200 pips. That could absolutely happen. I think there's a better than 50% chance that's going to happen either this week or next, prior going into the Christmas season here, because I know that if I was holding a long, for example, on Euro US, at the 139 or 137.50 level even, I would be very, very nervous right now. Very, very nervous. So be careful. Now, I know that FX Boyke is saying, do I hear a little Irish accent? No, us Canadians, I think our Irish accent, especially the people out east, it does kind of Newfoundland, stuff like that. But I'm in central Ontario, which is, so I didn't think I had too much of an accent, but I might. It's hard to say. So yeah, I'm going to hold out here for a few more questions before I wrap up, and I'll take the cue from FX Street when they would like to wrap up also. Now, once again, I want to thank everybody for attending the webinar this morning. We'll be doing 2 more in January, and we're going to start looking at doing some live trading in the webinars here. So we've spent some time going through the indicators and really trying to drive at home what we're looking for. And, when we're doing some of the live trading, we can really get a feel for things coming from long-term to short-term and how we want to play this and really simplify it for everybody. I have seen such complicated trading strategies where, in my opinion, even my chart is a little cluttered here. But I've seen charts where I could barely even see the black in the chart because there's so much stuff on there. Fibonacci waves, Elliott waves, this, that, 20 different moving averages. It can be very, very confusing, and that's what we don't want. We want to take the confusion out of this. We want to get you guys making money, and we want to get you guys enjoying trading, the main thing. So I think I'm good to wrap up here. Once again, guys, thanks a lot for showing up today in the webinar. Really appreciate it, and look forward to seeing everybody on the coming webinars in January. Thank you.